Afternoon, it's Bill Gross, the LA probate expert. And every Tuesday we get together for real estate investing zoom.com. We get together live on a Zoom call, as well as stream this live on YouTube and Facebook and other social medias. And then it gets put there afterwards as well. If you ever want to join us live, register at realestateinvestingzoom.com. You can come in and participate, ask questions of the host on a live basis. If you're watching live, again, just for security, we've been Zoom bombed a couple times. So when people come in, they're muted. If you raise your hand with the Zoom little hand thing there, or put a note in the chat box, we'll get you a question at the right time and ask you to unmute and have you unmute yourself at that point. But just for everybody's safety and security, we're going to keep it safe by keeping everybody muted, which is kind of weird. That said, I'm really excited to have today on our call special guests, Moses Lucero and Rich Neuharth. They are with Aviana Group. I keep getting it wrong because Aviana CAP Group, Aviana Capital Group, but it's Aviana Group. And Moses and Rich are the principals. I've seen them describe their program and opportunities to other people, and I found it fascinating. So I invited them to be our guest today. So guys, welcome to our call today. Rich, I need to get you unmuted. Let's see here real quick how we do that. I'm going to ask you to unmute there. Again, just because of security, we have to keep everybody muted, and then so those are watching, if you want to raise your hand or put it in the chat box, I want to meet you. Rich and Moses, welcome to our call today.
Thanks for having us.
Thanks so much for having us.
So, tell me about Aviana Group, how to get started, what was the impetus behind it, and where do you find yourself, how you define the unique opportunities that you bring to the marketplace today?
Great. Well, I'll go ahead. A little bit of background, just a backstory on myself. Came from single family. I got my introduction to commercial real estate. I was brought on as an acquisitions analyst for an investment firm here in Las Vegas. They focus primarily in multifamily. So I was just, the lead underwriter. I did a lot of investor relations, broker relations. And I've known Rich for many, many years, for at least 12 years. And so, he'll tell his side, but we kind of just reconnected, and we kind of just started Aviana Cap Group. We started about a little over a year ago, and we just been kind of trucking along ever since.
Nice.
Yeah.
Rich, how'd you get into real estate?
I started back 2008, 2009 during the crash. We were living in Las Vegas, so we were able to kind of see the economic trends and the way everything kind of collapsed overnight. And I wanted to learn more. So that's what my wife and I started doing, is we started finding ways to buy real estate, get into it. It was kind of a slow process starting out. Obviously, you gotta mess up quite a bit in the beginning before you figure things out yourself. It wasn't until 2012, 2014-ish timeframe where I started kicking things off. We acquired a pretty large rental portfolio across a couple of states, Las Vegas, Texas. I even own property in Alaska, and got to a certain level where we were managing all these properties ourselves. And even with a property manager, we just determined it was too much work, and it was kind of taking us in the wrong direction that we were initially intending on. So we started looking at multifamily in 2017, 2018, and really got a good groundwork in those first 2 years of what it actually takes to be a part of those. I mean, the numbers were huge, and it seemed like something so far out of our realm, but there were other people doing it. So we just kept educating ourselves, taking in as much content as we could, and meeting the right people. And then when Moses and I reconnected, and he was an underwriter and I was looking to get into it, we just, like you said, went from there, hit the ground running.
So today, you guys raise capital for your projects. Do you raise money from accredited investors only, or do you also have an unaccredited option?
So we do both 506B and 506C raises. The majority of ours are actually 506B, which means we can have up to 35 non-accredited investors, but we have to have a relationship established with those people. The downside that a lot of syndicators see in that is you can't publicly market it, but it's not an issue from where we're sitting.
Got it. And so again, just to recap, You have to have a prior relationship. And what's the minimum investment that you would take somebody in at that's not accredited?
So we have a couple of different options. We advertise that 50 to 75,000 is a normal investment. However, working with funds, hedge funds, we're actually looking at starting our own fund. We're able to drop that down quite a bit, $20,000 to $30,000 for getting people interested in being a part of what we're doing.
Got it. And so currently you just closed out an investment. You don't have anything right now that you're raising money for, if I remember correctly. But I asked you guys to come on today and maybe walk through a little bit about your products so people can kind of see what maybe at some point in the time they can reach out to you and invest with. So on your website, I noticed on the top, you have a property, Tanglewood Apartments, 160 units in Warner Robins, Georgia. And is that a typical investment? Is that what you've been doing over the last couple of years? Or is that a special superstar product, or how would you describe that?
So that was actually one of our first. We actually closed one just today, and it's in Atlanta, Georgia. This one's in Warner Robins, but these were our first two properties. We were part of the general partnership team that closed both of them together, so it was just one loan. And we've been executing the business plan since middle of last year.
And so the business plan, when you bought this, was there a value add component to it?
It was. So all of our properties have some sort of value add. What we like to do is go into properties that need renovations and that also need some sort of like managerial improvement. Maybe they're not operating as efficiently as they can, either not just the income, but the expenses as well.
Got it. And so by percentage, how much can you maybe review maybe Tanglewood? Do you remember what the acquisition cost was and the round numbers, approximately how much was value add to it?
Moses, you got those?
Not top of my head. I don't remember those ones off the top of my head.
Okay. So we purchased the property for $17 million. That was 275 units. And that ran right around mid 60s a door. And all of our properties, we're looking to add about 30 to 35% of value.
Got it. Less than that's kind of hard to buy something, I would think, because they're going to win a price. That seems like a sweet spot where you're not doing a construction job, but you're adding substantial value that you can capture when you're done, right?
Yeah.
And so that sounds great, the value add, but obviously there's a certain execution that's required to do that properly and do it profitably, right? So how do you guys, are you located in Warner Robins, or do you have team members you work with there? How did you manage getting that done successfully?
So we partner with some very experienced management groups. The group we're affiliated with, they have a very extensive relationship with some of these big property management groups. So we're usually on the same page. We do monthly GP calls with the other GP members, and just, we follow up with the leasing agents that's on property. And we just make sure things are, on schedule. With Tanglewood and the property below it, we were able to execute rents pre-renovation. So we haven't really got into turn units yet, but we're achieving pretty good rent bumps right now. And so that right there is just a good sign of just the overall market. And then obviously the execution of having the right people in place on property. Sometimes you're just going to have to, hire and fire on-site managers, trial and error, your maintenance guys. But luckily with this one, the maintenance guys that we had when we acquired the property, they knew the property inside and out. They knew what needed to be done. And we were on the same page.
So do you have set group of management you go to when you have a property in mind? Are you interviewing them as you're in the acquisition phase? At what point are you bringing in people to a project like this?
So typically we'll look at a couple. We have a couple different ones that we have a pretty good relationship with. We typically like to work with ones that are already established in the market. So we'll kind of we'll get budgets from about 2 or 3 every time we're doing an acquisition to see where everything's kind of fall. We kind of see where budgets are, what expenses are, what they think they can run the property at, and we kind of just level them out and compare them to our underwriting. But yeah, we typically like to work with someone that we have a relationship with. And we just kind of, we like to get at least 2 or 3 budgets on every acquisition just to try to see where things fall.
Is your latest acquisition the Adams House?
It is.
Yes.
So are you able to disclose what kind of returns you were offering when you raised the funds for that?
Yeah, absolutely. Since we closed today, we initially started, in the beginning, the returns were actually quite a bit lower. We were advertising 12% cash on cash, about 125% total return over a 6-year hold. And I think that turned out to about a 16.5% IRR. What we found basically over the course of closing the property, we were actually able to increase those because of how conservative we were initially. So, for instance, today our investors are part of the business plan, and it's like 15.8% cash on cash. It's still sitting right around 120 to 125% total return over 6 years, and it's about an 18% IRR.
Is that 50% out of the gate, or is that after the run-up period? Because you're obviously putting money in the property on the value add from the beginning. How do you manage the cash flow and the payouts?
Yeah, so we like to advertise to our investors that the first 3/4 or by 3rd quarter is when we'll start paying distributions. Now, the money accumulates. I mean, we've obviously taken that money, you're part of the business, so it starts accumulating from day one. But in order to make sure that we get on schedule and stay on schedule, we don't do distributions or plan distributions until 3rd quarter.
Got it. And then how long on this particular project do you have like the minimum lock in for the investment, and what's your projection?
When you say minimum
So investors' money is it at a minimum locked up for how long, and then what are you projecting past that? Meaning, at least when I've done these type of deals, you're not able to get any of the money back for the first 3 years or 4 years or something. There's a lockout period where you're committed at that point.
okay.
Do you have that kind of a process? I mean, if I decided I don't like you guys, I want my money back, can I get it back a year later, or am I committed through a certain period of time?
So when you sign the documents, it's all part of the legal agreement, the PPM disclosure that everybody has to sign. Once your money's in, it's in for 6 years. Now, that's not to say we have worked with investors actually on this deal. We had a gentleman, he needed to pull out. Things took a turn personally and financially. So we worked with him. We were able to give him his money back. But just once you sign up, generally your money is locked in for 6 years.
Right.
Or however long that planned business strategy is.
Right.
But through the value add, we're able to accelerate some of that based on when we have a capital event. So in this particular property, in year 3, we're planning a refinance, and we'll be refinancing and returning almost 75% of the investors' capital that they invested.
So obviously it sounds like you want to work with people when you can, but you can't do anything as a risky investment. So if it's minor circumstance, you'll do what you can do perhaps, but overall, if you're investing in this kind of investment, you should plan on your money being locked up for about 6 years minimum.
Yeah.
This isn't something to invest today and next year you're going to cash out and buy some cryptocurrency with it. This is a longer term, which I like actually, because now I can go back to work. I like these kind of investments myself. Yeah. Currently, I see that you have properties in Georgia. Is that where you are? Is that the exclusive area that you work in is in Georgia, or are you in other markets as well?
Moses, you want to take it?
Yeah, so we're focused in Georgia. Primarily, we're trying to migrate into Texas. So this coming year, we're focused pretty heavily in Texas, northern parts of Florida, South Carolina. But we're kind of branching out. We definitely are focusing more in those other states as well. Pretty much in the Sun Belt region. We like to take a look at everything. We also have had some really big interest on going up to Indianapolis or in Indiana. So we are looking at a few assets up there. We've got a few broker relationships up there that's kind of enticed us to go up there. I mean, they got some pretty landlord-friendly laws. And the price per door is still pretty reasonable.
Very reasonable.
Yeah.
I mean, I like Georgia, nothing against it. It's just personally, I'm looking to invest in Florida just because that's where I want to move. I want to kind of keep activity kind of in an area I keep an eye on. But Georgia's a great market economically and I think legally, and seems like tenant rights wise as an investor, seems like a great program. So again, for those of you on the call today, we got quite a nice turnout. Just for security, because we've got Zoom bombed a couple of times, we have to keep you muted by default. So there's two choices. If you want to make a comment or have a question, you can raise your hand. In Zoom, you have a little reaction, a little hand goes up, and whatever that looks like, and I'll call on you. Or in the chat box, just put a note that you have a question, and I'll do my best to look for those. We're also live streaming this on YouTube and Facebook, and theoretically, if you put your comments there, it would pop up as well, but I think it takes a little bit more time to get there. So I don't see any questions from other people. So I enjoy these conversations myself. So let's talk a little bit about, I don't know if you guys have heard, but interest rates have jumped up a little bit in the last few months.
Yeah.
Though last week it seemed like that kind of came to a halt for whatever reasons. What do you see as obviously, on one hand, I like your investments more in a expected increase of interest rates because rents will go up, I think, with inflation or keep up as a great hedge. And if your financing's locked in for 3, 5, 7, 10 years, you kind of beat the money that way. How do you see but I'm sure you're watching the interest rate market concerned about refinancing events and things like that, and it affects your return. What do you see as the interest rate market? And then more importantly, how do you see that affecting your investments over the next year or so?
So
and you're being recorded, by the way, so just a reminder. Sorry.
So the way it sits right now, we underwrite pretty conservatively as far as future events. So anything capital, depending whether it's our sale or a refinance, in 3 years, nobody knows what's going to happen. So we want to be as conservative as possible while still hitting our investment returns. The way that we have structured is we start out with long-term debt. So we've got a 5-year note essentially on both of these properties right now while we're going through the renovation process. And then at that point, we could even extend longer than that if we needed to. So if something happens, we can push that longer. We have that option that we've negotiated with our lenders. The end goal is to get into that long-term debt, that 10, 12-year note from Fannie or Freddie, and be able to ride out theoretically almost anything economic that could happen. I think where we're going to start seeing interest rates affect properties is in future valuations of, so let's say the properties that we're looking at now, if we close on those in 60 to 90 days, if interest rates go up, sellers aren't going to be able to sell for as high of a price as they are today. It's when your debt costs more, you're not going to be able to pay the same amount for a property. So I think we're going to see prices fluctuate a little bit. But as long as you're underwriting your properties appropriately, you've got the right team, I really don't see it affecting us too substantially.
Yeah, when we typically, when we underwrite properties too, we kind of like to beat it up as much as we can. We definitely do a stress test on it. We kind of run models on it to see at what vacancy can we operate at and still service the debt. At what rents can we operate at as a minimum, per unit and still service the debt. And also that we take account for the cap rate. We escalate the cap rate year over year too. Just because no one can predict, no one has a crystal ball. But that's some of the ways we conservatively kind of run the numbers, just to make sure the investment will still pan out. We tried to make it as risk tolerant as possible. There's no such thing as a guarantee in investing, so we try to mitigate as much as we can.
Seems to me as an investor, if I put my investment hat on for a second, and these products, I'm not a broker. I don't list or sell really apartments, and I don't really list or sell outside California. One of the reasons I'm looking to move out of California is if inflation goes up, rents may not go up to keep pace because of our restrictive rent control laws. In other markets, it seems to me that the inflation risk is maybe entirely offset by the possibility or the expectation that rents would go up at least with the rate of inflation. And that would really make your investments really look good, I would think. Now you have costs go up and your staff costs, your property management, costs go up, and all that goes up too. But if your top line income is going up at the same rate of inflation or higher, then it seemed to me like that's a great protection for your investment. Is that how you
make a great? Yeah, you make a great point, and I spoke to Rich about this. I know here on a municipality level, there's already city council talking about rent control and rent caps with the inflations, because affordability is getting pretty crazy right now. You have rents that are increasing double digits year over year. That's not how we underwrite our deals. We still conservatively, for rent growth, we do conservatively underwrite year over year, no more than 4% in a primary market. As a limited partner or passive investor, you really have to pay attention to those type of returns when someone's presenting a deal to you, and you have to really digest or dissect on where these returns are generating from. What is their rent growth? How are they calculating that? Are they calculating expense growth? And how are they calculating the cap rate increase, or if they are increasing the cap rate year over year? So these are all things we definitely account for. We do definitely pay attention to the micros, the microeconomic level of what's going on in the city, because there are talks. It's just rumblings right now, but we have to really account for any type of rent control or rent caps. You just got to be aware of that. We try to allocate that, or we try to forecast that in our underwriting as well. So.
Yeah, in California and LA, I think all bets are off. Who knows what the government's going to do? But I see some of these other cities. I was watching a presentation on an investment in a couple of cities in Arizona with all these big companies coming in and the growth of the tech sector and the growth of the battery sector and automobile manufacturing. And you're saying, well, obviously these people have to live somewhere. These are good jobs. They're making real money. This isn't Amazon warehouse space. This is engineers and assembly workers. And there's not enough housing anywhere in any city in America. There's not enough housing for these people. That's going to drive the rents up at some degree. But I guess at some point there might be political pressure, and you can just see that risk where they'll follow the California example and just say, let's just cap the rents, and that's where the whole thing starts to fall apart. But it seems to me, and that's why I'm so interested in this area. I'll share with you. I made a couple investments at the end of the year, and I was going to make a couple more, and I just got busy and didn't place it. And then I had to sit down with a wealth advisor in the family who was scolding me for being so heavy into real estate. I have real estate investments, and I'm with EXP Realty. I have a lot of stock with EXP Realty. My income is with real estate. He said, you need to divest. And so I kind of agreed and took a big chunk that I was going to put in real estate into wealth management. And I watched the stock market go down, down, down before I invested, and I felt great about it. But now they're saying, well, we'll put the money here, and what are you going to do with the cash? Well, you can buy stocks. Well, everything I'm looking at has just been battered for a month. And I'm looking at real estate saying, well, these rents are going to go up in Georgia. Like the thing you just closed, those rents are going to go up next year 10%. They have to, right? They have to go up. There's no other housing being built in most of these markets. It just seems like such a great opportunity. Why is it that you're looking to move then to other markets? You've done, it looks like, well in Georgia. You obviously have a team and people in place. What is it about Texas and Florida? Though I love Florida, don't get me wrong, and I see why other markets are good, but what's driving you to move out of those out of Georgia into, rather than specializing in it, maybe focusing on the markets?
Well, we want to have a vast portfolio. So there are some investors that they see people investing in Georgia or Texas or even Florida, and they, it's kind of like the bandwagon investments. Everybody's trying to get there right now. But that doesn't mean that all these other markets are bad. I mean, there are plenty of other states that are landlord friendly. They have significant economic growth. They have population growth, income, they hit all these other marks. And Texas and Georgia may not necessarily be for everybody else. We want to go where we can operate properties efficiently and get our investors the types of returns that they're expecting, that we would expect when we put our money into deals. And areas in like the Midwest, like Indiana, we're talking about, it's not such a hot, sexy, attractive market, but we're seeing that we can hit these returns and we can operate these properties just as efficiently there. And it meets all these other economic drivers that we look for when we are determining which states to be in ultimately.
Some of these regions are just going nuts with the redistribution of work, online and warehouse space and logistics and so on, just really changing landscape. And so places like Indiana, I understand some parts are just on fire as well. So good for you for branching out. Is part of it, I mean, I don't know if you want to admit this or not, but is part of it driving it just you personally want to diversify your investments to some of these other areas? Is that part of what's behind all this?
Well, Moses and I have talks quite a bit, and we talk with our key sponsors and, people that have way more experience even than we do. And when you look at areas in Florida, there are some of these like 1970s and 80s properties, and they're trading at $250,000 plus a door. Well, what I see is I could buy a house for that almost in
Yeah.
most of these markets.
Yeah.
So how much higher can I expect that the pricing of that property to go up? You know, even in Texas, I mean, in Dallas, we were just looking at before this phone call, 240,000 for
325,000 in Addison per
yeah,
unit.
there you go. You know, for
Yeah.
a mid-80s product. Like that's the average price of a house in certain areas around DFW. So do we want to continue to invest in those, you know, properties and just plan on that significant escalation in price? Because when you think about, okay, we're adding 30% of value to almost every property we buy. Well, what's 30% of $350,000? Yeah, that's a lot. So we don't, I'm not in the class A, the high end Grant Cardone type stuff. We are very interested in the B and C type assets that are mid-range, affordable, you know, but they need that love. They need to be worked a little bit and brought up to market. You know, if anybody's into stock investing like Warren Buffett, it's that value add. You're a value investor. You have to buy at a certain price and you bring it up to the market. You know, we're not pushing the market necessarily.
What's the property, when you buy a property that's going to be a B class property, before you do the value add, what's it like when you're buying it? What's the condition? Is it B
Typically,
class at that time, or is it below that?
It could be a B minus C plus. I mean, those are kind of your go-to properties that you would really want to strive to get is your C property in a B area. You know, something that's kind of mismanaged, something needs a little bit repositioned, and it's some deferred maintenance. You know, if it's got some dated appliances, something that's kind of dragging behind the market, the local, you know, macro market of it. But yeah, those you know, you can find. I mean, they're a little harder to find now, but those are types of properties we like to kind of go after too as well. So we like, you know, workforce housing, traditional multifamily housing, and we also look at, you know, B areas. You know, what particular assets lagging in that type of area.
Now, every investor, you know, tells you that they make the money on the purchase, not on the sale. So obviously, you guys must be putting a lot of energy into looking for deals. The other thing I hear, you know, a statistic I get regularly when I ask investors is they're looking at 100 deals for every one they buy, and of late that number is more like 150. They look at and they run their numbers at some level before they buy one. So how do you manage that process? Are you looking at 150 deals or more? Is there any particular focus you have on finding deals? Obviously, it's not a trade secret because you're not the only one out looking for property. Any input you have to investors on that?
Primarily our deal sources, I would say 95% from brokers. We've established a very good relationship with a lot of brokers and property managers where we kind of get a first jab at anything that's going to come to market. But yeah, we typically like to find things that are quote unquote off market. There's not really anything that's really off market anymore nowadays. But if we can get first glance at it, you know, we're in a small group of maybe 10 investors that get a first jab to quickly underwrite the deal, see if it pencils out real quick, maybe send it to our vendors, get some quotes back. And if it still pencils out, we definitely like to look for, you know, any type of deal that's accepting preemptive offers. And we just kind of have that conversation, that dialogue with the broker saying, hey, where do we need to be at? What does the LOI need to be? What are they expecting the LOI? You know, what kind of earnest money are they looking for? And if we can just hit those certain metrics that the seller's looking for and just send in an LOI before it even gets to full market. I mean, those are typically the types of deals we like to look for. Those are the types of brokers we work with. But that's primarily most of our deal source is that way.
So you get deals from brokers, which is, I mean, I like hearing that, I guess. But the broker has to really know your particular profile, right? Because I'm not going to bring you a Class A market deal just based on what you told me. And I'm not going to bring Grant Cardone a C plus and a B market because he's not going to be interested. Well, to his credit, I think he has a niche and a plan and a system, and he's working that system, right, at a high volume. So, and likewise, I wouldn't bring those to you, I don't think. So good to know for everybody here on the call. You guys have obviously moved up the food chain, though not too long ago, and made a nice impact in the marketplace. On our call today, we have some experienced investors, but I know I get asked regularly from brand new people, how do I get started? To me, the advantage of working with a company like you would be to learn kind of your process of investing some money, rather than put my life savings into my own building and then I see people fall apart, along the way. Investing and at least kind of learning along the way with somebody who's done this. What's your best advice for a new investor once they get started? I know that's not what you're looking for to build a business based on, but you guys are obviously, I know you both come from a heart of serving people and providing value. What would you recommend to somebody who's new, looking to start? Maybe they have some money, maybe they have some savings, but they're scared to make that first commitment or first investment. How would you recommend them to move forward?
I think first and foremost is 100% educate yourself. And even if you're not a numbers person or a spreadsheet type of person, I would highly, highly recommend learn just the basics of underwriting. Learn how to underwrite and evaluate a property. Learn how you derive returns from a T12, or extract data and put it into a spreadsheet, whatever model you want to use. I feel like underwriting is one of those I don't want to say underappreciated things, but it's something that whether you're an LP or a GP in anything, any deal, I think it's very foundational to learn underwriting, to really understand how the numbers work. How do you crunch the numbers? Even if it's not something you like to do, I believe it's one of those foundational things that has to be, acknowledged. But I think educating yourself, just learning the basics of underwriting, so you feel comfortable enough. So if someone approached you with the deal, you know how to look at it and you know how to determine if the assumptions were aggressive or if the assumptions were correct enough or if they were on point. But yeah, that's kind of where I would tell someone who's new starting out.
Rich, you anything to that?
Yeah, I would say from what we know of most syndicators and people in real estate, it's about time. Time's really, really important to everybody. We're all trying to do more with less and, maximize every waking moment of the day. And to just be able to provide time to somebody else and whatever your specialty is, I've met people that have never raised a dollar that are really good at raising dollars. People are very experienced with looking at Excel spreadsheets or, things people don't talk about, organizational skills, data entry, making phone calls, talking with brokers, keeping notes on people that you talk to. Those are all very valuable skills that we hire out or we look for in our teammates when we're bringing on somebody new. So when somebody has a huge interest in it, you find what you enjoy doing that somebody else doesn't enjoy doing, and then try to do that there. I think also surrounding yourself with people. We go to a lot of networking events. We're on a lot of these calls. It doesn't matter if you want to be a master mechanic, hang out with master mechanics. If you want to do real estate, hang out with real estate people. If it's, single family or multifamily, find that niche group and spend your time there, and you'll learn a lot.
That's really why I started this call myself, to be quite honest. I was going to an event that shut down with the pandemic and I missed it. And real estate really is a team sport. Doesn't seem like it, but it really is in my experience. And I started this call looking for deals. And last year I found two nice investments as a result on this call. And year before that, I probably did more than that last year. I also did a couple flips earlier in the year. So I'd say for me, I'm always looking for people who have a problem and need some help. And they need some capital or expertise. I can help them with that. I'm glad to. And for all of you on the call, I would say it's about networking, and that's why I do this. And if you have property that you want to present to our group, feel free to send it to me ahead of time. I'm glad to support people who are raising money or trying to sell property. And that's what this is about, is really trying to develop a network of people working together more than anything else. Okay, anybody else have any questions? I could talk to these guys forever. They don't come here just to talk to me. But if you have a question, put it in the chat box or raise your hand on Zoom. And the goal here is to be interactive. If you have a question, don't worry if somebody else has the same one, or we'll appreciate it. I assure you that you're asking the question will help one or two other people as well. We do record this, so other people will hear the same thing down the road. So your next step, it looks like, is raising money and building projects outside of Georgia. Is that something that you're excited about? Is that something you're a little nervous about? Like, to me, it seems like a big change in your direction over the last couple of years.
Not so
Bit of both.
much. It's finding the right teammates. We are kind of stepping back from raising our own capital, although we are always raising capital. You always have to work with your investors and keep them engaged, and helping them ultimately deal with one of their problems is they've got money and they don't know where to put it. And so we need to help them, but we're stepping back a little bit from primarily helping other people fund their deals and focusing more on closing more of our own. So for instance, last year we did $50 million worth of properties. And this year we're looking to double that. So by Q4, we're looking to be at about $100 million under management just in 2022.
Nice. Well, it makes sense, right? I mean, if deals are more and more scarce, it makes sense, and you've had some success, that more and more of your business would be for yourself. I feel the same way myself. I've been very busy in the past helping customers, and at the end of last year, I got a little more serious about my own investments, and I need to continue that myself as well. Arthur asked a question: are you guys open to somebody else raising capital, and as part of your team? Are you looking for people who have, clients have people with money? Is that something that, like you said, you're looking to raise less, but if somebody had some capital available, that's something you're looking to work with other people?
Yeah. So actually on this Atlanta deal, we put in a significant portion of hard earnest money from day one. And then we agreed to additionally raise some capital, but we had just come out of a capital raise. So you can only go to the honeypot so many times. And we actually partnered with another group, and they were kind of a first time group, but they had some really good backing to them, and they were able to help us raise some capital. So we were able to get them their first general partnership portion. They'll be getting paid here in a day or two, and everybody gets ownership in the property. So yeah, we're always looking for capital raisers.
Got it. Okay, good. And so your website would be a great place to start, probably with contacting for that. Avraham Gordon, who was one of our guests a couple of weeks ago, asked, what do you look for as cash on cash return if you're to acquire a fully performing property? Now, that's not really your game plan is almost always going to be value add. So, but I imagine when you buy the property, there's some sort of cash return initially before you get started on the value add piece. What kind of cash on cash return are you looking for as an initial return before you get started? Or is that important to you? No,
absolutely it is. We look for day one cash flow, meaning the day we close the property, it's cash flow positive, and then we don't have to worry about mixing and mingling those funds. Our minimum criteria is 8 and 15, 8% cash on cash, 15% IRR. Now, if we were going to buy 100% stabilized, maybe like a B plus asset, we'd be looking at funding it a little bit different, either through a preferred equity group or a family office or something like that, somebody that we can partner with, in which case we could probably lower returns down to that probably 5 or 6% cash on cash and a 12 to 13 or 10 to 13% IRR.
Did that help answer your question, Avram? Yeah. So that's interesting. I didn't really think about, but I guess day one, if it's not cash flowing day one, that's a whole different ball game. Digging a property out of a hole while you're getting your plans done, and that drags out, then you have a real problem on your hands. So to be avoided.
Yeah.
Well, look, I enjoy this. Personally, I'm interested in seeing your next projects, and in particular, if you got something in Florida, I might look at Georgia again. But to be selfish and honest about the whole thing. I find you guys interesting, and I'm anxious to see you guys move into Florida if that works out. But at the same time, I appreciate on behalf of everybody else, you guys are kind of opening up a little bit. And again, if they want to reach you, the best place with the website is Aviana Cap Group, AVINA Cap Group, GROUP.com. Best place to reach you there, and there's a contact, or is there some other way that people should get in touch with you if they're interested?
Yeah, actually, so the website is a great way. It's nice, simple, easy to get a hold of us. But what I'm going to do is I'm actually going to post. I've got contact information directly for each of us. I'll
Got it.
drop it in the chat here in just a second.
Good. We'll
Kind
put
of,
that.
kind of a shameless plug too. I mean, if anyone's really interested in the commercial multifamily space, Rich and I, we do host a Thursday meetup. We'll get that information up on the chat too. But every Thursday we sit around, we talk with some very experienced lenders, operators, capital raisers. There's some good individuals on there. There's some vendors that come on there too as well. We're doing a monthly kind of like an underwriting session, an open Q&A, where we kind of just, we take a deal, or someone brings a deal, we'll bring one of our own deals and we kind of underwrite it in 60 minutes and just kind of give a high level overview of how we look at deals, how we underwrite deals. And we just kind of pencil it out real quick and kind of give our little thoughts on why it would work or why it wouldn't work and at what price would it work at. But yeah, we do that every month as well.
Your Thursday call is a Tangible Thursdays. Is that you guys?
Yes.
Yeah, I didn't know it was you when I found it, or somebody recommended it, and I stumbled in there. That is like, you better put your big boy pants on, your big girl pants on when you go in there. Those are, you guys are operators, just which I'm just a passive investor and I find it fascinating. But you guys really get into some detail there and get some real high level vendors. At least a couple I stumbled into.
Yeah, we get some passive investors that come in on those calls too. And I think it's very great for a passive investor because it goes inside the conversation and the mindset of a general partner and how they, how they look at deals or what kind of strategies they're looking at. And just, even like the market, what's happening in the market. We had a Thursday call a couple of weeks ago and we talked about the rates, and it was a very good conversation. We had someone from Meridian Capital Group that was on the call, and he provided some very good insight on where the rates are and, how lending's adjusting from his standpoint. So, I mean, we get some very experienced people on the call and we kind of just toss around. It's an open forum. So it's just kind of an open conversation. We just trade thoughts and ideas and kind of mastermind.
Is the monthly underwriting one of the weekly calls every month, or is that a separate
that's
meeting?
totally separate. It's separate. Yeah.
Okay. So if you have that, either send it to me or put it in the chat box and we'll get that in the chat notes if people are interested to jump in. I'd like to jump in on that. That sounds interesting. I know they had it, good. Dave Weineman, I see your hand on the computer in front of the camera. Either adjusting your camera or you have a question. You should be able to unmute yourself. No? Let me see if I can unmute you.
My keyboard died. That's why it didn't work.
Yeah, you just have to. Dave, I don't see where I can. Oh, I know it. You're under iPhone. That's why. Hold on. There we go. You have to unmute yourself.
Hey,
there you go.
Bill, thank you. Thank you so much. I'm actually working with an associate of mine who's new to your group, and I think he had a couple of questions. And since I'm a little bit more, at least I know you a little better, I just decided to just horn my way in here. But you know me, I'm not bashful, Bill. Do you want to just, Arthur Howdy?
No, he could have let me in here.
Yeah. Oh, yeah. Well, I think that I was able to get your attention. Anyway, do you want to, is there a chance that Arthur might have a chance to ask a question, or do we not have time?
Sure. Arthur has a question. Yeah, go ahead, Arthur. You have to unmute yourself.
All right, perfect. Hey, guys. Hey, it really enjoyed Rich and Moses, what you guys are doing. You know, prior to COVID, I was actually, hold on a minute. Do you mind? It's getting a reverb.
Yeah, sorry,
I just had him go in the other room because it's getting reverb. Anyway, just wanted to say, you know, prior to COVID, I was privy to be involved in multifamily add value space and was privy to a lot of the events that happened here in Los Angeles. I was with a company called Strategic Legacy Investment Group. It was a nice group here out of LA. They had a lot of speaking engagements. So I really paid attention to this space and cap rates and what's going on here with multifamily. But one of the things I did keep during the, the break from COVID is I kept all my contacts. So if you know, behind me is the name of my company, Acord Threefold LLC, and we're based out of Century City here. And my son and I, after spending time golfing for the first, half a year of the COVID, we decided to start, bringing. I was finding a lot of investors out there on the golf course, and I just got back into raising capital. And you guys mentioned sometimes people that don't even have the experience are some of the best capital raisers. But I fell into it. I raise capital for a lot of different sectors, the movie industry, you know, short films, private, you know, indie films, all kinds of stuff. Dave's my really good friend. I've met you, Bill Gross. I know we've met in person, but when I heard you talking, I said, Mina, I got a lot of investors that are looking to get into this space. You know, I'd like to talk to you, a little more directly. I reached out to you, Rich, send you my contact information, but it's really nice. I'd like to really participate in your Thursday, you know, doing the underwriting, getting into what you're looking for in terms of a deal. And that's something I really want to learn. So I'd like to learn a little bit more from you guys, and maybe we can work together and make some money this year and help some families out there, because there's a lot of opportunity, you know, and you guys, you know, smart guys like you guys that are doing it right. And you're right, you know, I follow guys like Grant Cardone and kind of understand his style, but to see there's a lot of, you know, B and C, you know, assets out that are still really good assets to own. You know, I personally I have an acquisitions team that makes about 700 dials a day using an AI system, and we're getting a lot of hits on, you know, wholesales, you know, in the multifamily 8 to 15 units, also in, you know, in the residential. It's a lot of people that are leaving California, I think, for Texas and other places because it's just getting too expensive here.
Right.
Yeah.
Well, great.
Yeah, absolutely.
Okay, so
Yeah,
you guys,
I got your message. Thanks. I'll definitely reach out to you. Feel free. I dropped both Moses and mine. We got links to Calendly, the Thursday event, and some social media platforms. So yeah, we'll definitely get in touch after this. Thanks.
Nice.
Great.
Good to meet you guys. This was great,
Nice
Bill.
to meet you, Arthur.
Yeah.
Thanks, Arthur.
All right, guys.
Riley,
Welcome.
I see your hand up. How can we help you? Let's see, asked you to unmute. There you go.
There we go. So you mentioned that you were going to raise a fund because you had some institutional capital. Have they placed with you already?
So what we actually have is we've got kind of a unique fund that was brought to us. It's a little less traditional. It's an ongoing fund, so we get to continually raise for it. We're still in the beginning processes of it, but what it allows us to do is either do a 506B or a 506C, but we can drop down, so we could bring in investors at, you know, $5,000 or $10,000, and then what they do is they have access to this buffet style of portfolio, if you will, and then they get to pick which property they want to put their money into, and we take it to each individual lead or, you know, key sponsor, and we negotiate a portion of ownership on our own behalf. But as far as the traditional fund, that's not really something we're interested in. We do have people that we partner with that manage those funds, but nothing institutional yet.
Sorry. So I'm curious. So with the institutional capital, have they signed like some sort of MOU, or have they given you what their parameters are, what their minimum placement is for when you do open your fund?
No, so this is like, when I say beginning stages, I mean infancy. I had a phone call week and a half, 2 weeks ago with Badri, and we really talked about kind of the basics of how it was. So yeah, this is something definitely new to us. Do you manage a fund, or is that?
So I just acquired 54 units in Little Rock a few months ago, and right now I'm kind of in a similar situation where I've got institutional capital that's interested, but I don't have a fund to accept it, and so I've got to get the fund and go back. And through it, I've been shoring up those contacts.
Yeah.
Figuring out really clearly what they want, and entering into more or less a pledge agreement where there's legal implications if they end up not investing.
Okay.
Rather than just saying, "Oh yeah, I'm interested," you know, they've got to get behind it, and they all fell through. So. I mean, some of them had some really ridiculous IRR expectations.
Yeah.
And there
We've seen that too.
had a high minimum placement, but they didn't want to be more than like 20% of the total capital raise.
Okay.
Right out of the gate, we'd have to raise like $100 million fund. So a lot of the issues came up to the surface when I started trying to shore up those contacts. So I was curious if you guys had done that yet, so I might be able to avoid some more of those obstacles, because it's been brutal.
We haven't yet. Just we tend to stay away from that institutional. Here's the problem: when it gets into multifamily, like what we're doing, they want a lot of control, and I would say rightfully so. If they bring that much money to the table, I would want a certain level of control too. But what makes a really good syndication team is letting them run their business plan and not forcing them to run something that's not natural to them. Everybody's got a different style. Institutional buyers, they don't always have that same vision, but it definitely has its place. We've used private equity on deals before. We have a family office. We have pretty good solid contacts with private equity groups. We just haven't created our own fund and gotten the institutional money to invest with us yet. In the fund side, individual properties we have.
Full discretionary control is definitely difficult to get.
Yeah, if you want to have a conversation, feel free. Like I said, the Calendly's up there. We'll schedule some one-on-one time and talk about it, see if we can help them or get you guys set up in the right direction. And we've definitely got, if we don't know the answers, we know the people that do.
And if anybody who's on the call or maybe misses the details, if I can help, is anybody I have their contact info, feel free to reach out to me. I'd be glad to put it together. As appreciation, I really appreciate you guys going in, a pretty deep dive on what you guys are doing. And without being able to raise capital today, I appreciate you investing the time in my time, as well as the people on the call today. So on behalf of everybody here today, thank you guys, Rich and Moses, thank you so much for being on today. I really appreciate your giving back to the community, and wish you the best of luck as you guys continue to grow and as you branch out, and hopefully get a chance to maybe work together along the way. So thanks so much. And for the rest of you, we do this every Tuesday at 3 p.m. Pacific time. It's realestateinvestingzoom.com. You can come in live and participate, ask questions, hit the chat box. Just promise not to Zoom bomb us, and we'd be glad to have you come back again sometime. And also, we live stream it to YouTube and Facebook if you want to watch it there. I'm Bill Gross, a LA real estate broker. If I can help in any way, please let me know. Thanks so much. Make it a great week, everybody. Thanks so much, guys.